Hello everyone, my name is Abhishek. Welcome to my channel Data Scientist. Today I'm going to talk about a topic called bond market. I will be covering three major areas under this topic. First, I will be discussing about bonds. What are bonds? Second, I will be interested to discuss about what are bond pricing, how you price a bond, and finally the factors driving bond markets. What are bonds? Bonds are financial instruments which pays you fixed return over a period of time. The investor needs to make an initial investment. There are two types of bonds, short-term and long-term. Short-term bonds are more of a money market instrument, similar to fixed deposits. Longer-term bonds are in general government bonds having maturities greater than or equal to 10 years. Bonds can also be classified as government bonds and corporate bonds. Government bonds are usually considered to be less risky. However, this is not 100% true because we have seen historically that governments going bust for countries like Argentina, like Greece, for example. Corporate bonds have credit risk. Credit rating agencies assign scores that reflects the default probability. Larger institutional investors generally trade bonds and have large impact on other financial markets. So we take the bond market cues or directions to judge how the equity market is going to move. How do we do bond pricing? This is a very important element of bond market. Before I go ahead and discuss about the bond pricing, it is utmost important for us to understand three concepts. What is coupon rate, and bond yield? So coupon is nothing but an annual interest paid to the holder of the bond in exchange of the initial investment. The interest which is paid to the holder of the bond will have a rate assigned. The annual interest rate paid to the holder of the bond is basically my coupon rate. The holder receives the full face value of the bond at the maturity. What is bond yield? The discounted cash flow of the bond at the appropriate discount rate is called the yield. The yield is single discount rate that equates the discounted future cash flows of the bond to its present price. So it's basically more of a discounted future cash flow which we are considering at today's time point. Now if we consider the equation which I have written over here is basically my present value of the bond price reflecting by PV, which is basically my summation of C multiplied by F. So C is my coupon rate and F is the face value of the bond whole divided by 1 plus R, which is basically my bond yield or the discount rate whole to the power of T. T is basically the time period, plus again my face value whole divided by 1 plus R whole to the power capital T. So 1 plus R is basically my the bond yield plus my first period, and I'm actually doing a multiplication keeping in mind the time period T, capital T. It is very important for us to understand that how the bond price moves with different scenarios. The bond price and the bond yield have an inverse relationship. If the yield goes up, bond price goes down. If the coupon rate is higher than the yield, the bond's price is above the face value and trades at a premium. If the coupon rate is lower than the yield, the bond's price is below the face value and trades at a discount. If the coupon rate is equal to the yield, the bond's price is equal to the face value and trades at par. Factors driving bond markets. Being an investor, it is very important for us to understand what are the factors which drives bond market. And I have listed the following four factors which in generally have a very pivotal role to play in terms of bond prices. First is the interest rate. Interest rates are directly correlated with the yield of the bond. Interest rates have an inverse relationship with the bond prices. Bond prices rise if interest rate decreases. Duration measures the effect of an interest rate change on the price of a bond. Longer the maturity, greater is the duration. That means if the interest rate goes up, the bond price will fall. The second factor would be the inflation. Inflation reduces the value of the bond by reducing the real value of the fixed payments. Because today's worth of $1 won't be a $1 in the next year. It will get adjusted by the inflation. Whether it's 5% or 2%, that depends. However, that has to be adjusted with our inflation rate. Long-term bonds have greater inflation risk than shorter-term bonds. In general, the initial yield of the bond captures the inflation expectations. The third factor is the default factor. When the bond issuer doesn't pay the holder of the bond, it is called the default risk. The default risk is applicable to all corporate and government bonds. The credit rating agencies assign a rating to each bond, and the rating reflects the probability of default. The last factor is the different macroeconomic factors. The risk-free bonds tend to perform well when economic news are not that great. Okay, so that means when equity market is doing very well, the bond market doesn't do that well. However, when there are some jitters in the equity market, bond markets starts performing well. Bonds are typically considered to be a safe investment while investors wish to get out of the equity market. So this is very important from an investor standpoint, one should know. Um, Majorly I've covered all the topics which I wanted to cover under the introduction of bond markets. I wish you enjoyed the topic. Let me know if you have any feedback, comments, and you can of course mail me in datasciencefortrading@gmail.com. Thank you for watching the video.